You know, exchange-traded funds, or ETFs, have totally changed the game for millions of investors. They're fantastic. But in this never-ending search for more income, a new and way riskier type of ETF has shown up, and it promises payouts not every quarter, not even every month, but every single week. It sounds incredible, right? But you gotta ask, is it too good to be true? Okay, let's get into it.
So here's our roadmap for this explainer. We're going to start with why ETFs are so popular in the first place. Then we'll cover some of the usual risks. After that, we'll peel back the curtain on these new weekly income funds to see how they actually work. And this is the big one. We'll see if those huge payouts actually lead to real returns. Then we'll wrap up with a much smarter way to think about income investing.
So first things first, let's just set the stage a little bit and talk about why ETFs became such a massive deal for regular investors like you and me.
At their heart, the idea is just brilliantly simple. An ETF lets you buy an entire bucket of investments, say the whole S&P 500, with just one click. It's like instant diversification, and you can trade it as easily as a single stock. For most folks, it's an absolutely fantastic tool.
But, and this is a big but, with any financial product, simple doesn't mean there aren't any risks. Even the most basic ETFs have costs and potential traps that you absolutely have to know about before you put your money in.
Okay, so these are pretty much the standard risks for any ETF. You might have trading fees, maybe the fund is thinly traded, which makes it hard to sell, and of course, if the stocks inside the fund go down, your ETF goes down. But the one I really want to zoom in on, the one that's like a silent drag on your money year after year, is the expense ratio.
So what is the expense ratio? Well, it's the fee you pay the fund manager every year. And it's sneaky because you don't get a bill for it. It just gets skimmed right off the top of your returns. So if your fund goes up 10%, but the expense ratio is 1%, you only actually get 9%. It doesn't sound like much, but trust me, over time, that really adds up.
And you can really see how this works right here. A plain vanilla passive ETF that just follows something like the S&P 500 might have a tiny fee, like less than 1/10 of 1%. But the second you get into these more complex, actively managed funds that use things like covered calls, look at that fee. It explodes, often 6 times higher or even more. Always remember that. Complexity is going to cost you.
All right, so with all that in mind, let's get to the main event. These new, super complex funds that are dangling what seems like the holy grail for income investors, a paycheck every single week.
Just listen to the marketing language they use. Harness volatility. I mean, volatility is normally the thing investors run away from, right? But they're telling you they can tame it and turn it into a cash flow machine for you. It's a very tempting pitch.
Now, the companies behind these are specialists like Roundhill and YieldMax, and their whole strategy is built on a couple of key things. First, they focus on just one super volatile stock at a time, like a Tesla or an NVIDIA. And second, they use some really complicated derivatives like swaps and these things called zero data expiration options, which are basically super short-term bets to try and squeeze out those weekly payments.
So how in the world do they actually do that? How do they take all that volatility and complexity and turn it into a check for you? Well, this is where we have to pop the hood and look at the engine, because it's nothing like a normal dividend stock.
This table really lays it all out. Down at the bottom, you've got your classic quarterly dividend ETF, like SCHD. Super simple. The income comes from company profits, and the risk is just the normal stock market going up and down. Move up a level to the monthly funds, and they use options to generate more income, but it caps your potential gains. Now look at the top. The weekly funds are using leverage, swaps, single stocks, and zero DTE options. And just look at their key risks: leverage risk, and get this, full downside, capped upside.
Let's really hammer that point home because it's everything. Full downside, capped upside. That's the deal you're making with these strategies. It means if the stock they're tracking goes to the moon, your gains are capped. You only get a tiny slice of that. But if the stock completely tanks, oh, you get to experience all of that pain. You get all of the downside. It's a bet that's structurally skewed against you.
And that leads us to the single most important question you can ask about any investment. It's cool to get a weekly check, sure, but are you actually getting richer? We have to look past the flashy payout number and focus on the only thing that really matters: total return.
So think about it. If your upside is capped, but your downside is unlimited, and you're betting on crazy volatile stocks, where is all this money for the massive payouts coming from every single week? Is it magic? Is it profit?
The answer
and this is so important to understand, is often something called return of capital. And let me be perfectly clear, return of capital is not profit. It's not a dividend. It is the fund literally taking a piece of your original investment and just handing it back to you. Think of it like getting a partial refund for something you bought, which of course means the thing you still own is now worth less.
And if you want to see just how extreme this can be, look at this. This is from the fund's own documents. The estimated makeup of the payout for the Roundhill NFLX Weekly Pay ETF was 100% return of capital. 100%. Every single penny they paid out was just investors' own money being returned to them.
The research paper we're pulling from just nails it with this quote. When the payout is just your own money coming back to you from a fund that is also falling in value, that's not income. It is a tax-deferred liquidation of principal. Let me translate that. It means the fund is basically selling itself off piece by piece and giving you the scraps, all while you're being told you're earning a high income.
And the end result of this process, well, it's a disaster. Just look at this chart. This is total return, so that's the change in the fund's price plus all the payouts over 6 months. The S&P 500, up over 5.5%. A typical monthly income fund, up a little over 1%. And the weekly income ETF, even with all those huge weekly payouts, its total return was negative 13.74%. It was literally lighting investors' money on fire.
Okay, so seeing all that, how should someone who actually needs income from their investments approach this? Well, it's about shifting your focus away from the shiny objects and looking at what's really going on.
Here's a really simple 3-step playbook. First, always focus on total return. A 50% yield means nothing if the fund loses 60% of its value. Second, you have to know where the money is coming from. Is it from real company profits, or is the fund just handing you back your own cash? And third, match the strategy to what you're trying to do. Use traditional dividend funds for long-term wealth building, and maybe, just maybe, use these other income strategies very cautiously, if at all.
So, let's just boil it all down. These weekly income ETFs use extremely risky, complex strategies. Their giant payouts are often not real profit, but are just your own money coming back to you. And so far, the evidence shows that this has led to a massive destruction of capital, which is the exact opposite of what you want from an investment. And that really leaves us with the one final question you have to ask yourself about any income investment you own. Are you actually getting paid a profit from your investment? Or are you just paying yourself with your own money while the whole thing slowly disappears? The difference? Well, the difference is everything.